Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, retirement planning specialist and the world's friendliest financial fiduciary, Tony Walker. And today we are in part 3 of basically the theme kind of is counting the cost of doing business with any advisor, including Tony Walker Financial. Will cover that, but we're going to deal specifically with fees. Oh, before we get started with our show and introducing our guest here in the studio, we got to talk about counting the cost because of this little baby. There we go. There's my favorite son-in-law, Trey, and my favorite daughter, Lacey. Just had a young lady by the name of Ellis Eve. Is that correct, Trey?
Yeah, she wasn't, I think, 12 hours old at the time. And Lacey's sitting there in recovery. We're all just kind of hanging out. And then here comes Poodles on the TV, Tony Walker Financial commercial. And the nurses got a kick out of it that she got to see her grandpa on TV before in person.
Well, one of our clients yesterday, Wes, was kidding us about how much we do on advertising. Lacey, it was funny. Someone came in to talk to Lacey while she was in the hospital bed getting information and started asking about, do you work outside the household? What does your husband do? And I think she said, well, my husband works in the financial world, something to that effect. And she goes, well, where does he work? And all of a sudden, one of my commercials came on. She goes, she works for that guy.
Yeah.
She goes, oh, Tony Walker. So, yeah, we do advertise a lot, but hey, luckily for us, Ellis is getting a good exposure to Tony Walker Financial at a young age. That's a great pick. Thank you.
Worry-free.
And congratulations, by the way.
Thank you.
All right. And now magically in the screen is our own Heather Hughes, our fiduciary in the Bowling Green office. And, of course, official introductions. We've already introduced Trey. He is a fiduciary in the Louisville office. And, of course, my favorite nephew, Wes Walker. So thanks again for being a part of our podcast format, as we're calling it. And we're on part 3 with fees. So, Trey, I'll start with you. I mean, you know my passion for understanding fees and costs and why I'm so concerned with maybe the fees that are being charged to a lot of savers out there.
Yeah, it's for savers when they kind of go into this retirement planning lifestyle, they're used to 401ks, employer plans that are very low cost. And there's this huge push by the DOL, rightfully so, that fees and commissions and everything is disclosed. And we're very forthright about telling people what it costs to do business with Tony Walker Financial. They never write checks to Tony Walker Financial.
Which is a mystery for some people. They're like, I don't understand how y'all make money.
Exactly. So there's commissions, there's fees. We disclose all of that. Unfortunately, in the financial world, sometimes savers are surprised by what fees they're actually paying.
And speak to he mentioned the DOL, Heather. What is the definition of the DOL? That's an acronym, obviously. And this idea of these 8424s that we have to provide to our clients. What's the purpose of those 8424s?
Yes. So the Department of Labor several years ago required that anytime someone is moving from a 401k, 403b, any kind of employer plan to an IRA via rollover, that it is disclosed on what they're moving from to what they're moving to. So we look at things in terms of what their employer plan can provide in terms of service, expertise, tax planning, annuity planning, things like that, as well as their investment options and the costs associated with the current employer plan and what we would be proposing to move to. In that document, we also disclose how we're getting paid, if we are recommending any kind of commission product, what that commission is, and further details on annuities if that's what part of our proposal.
And, Wes, you're heavily involved in the investment department. I mean, for those flying under the radar and not doing some of these steps, non-fiduciaries or probably even some of fiduciaries skip these steps. As much business as we do, how much time constraint is that on us to make sure we're staying afloat with the DOL and these 8424s?
Regulatory compliance is a huge issue in the financial world. I mean, really, with any industry, if you don't know about it, it can be so opaque to the outside person. I dropped my car off for a service this morning. They could put a, bulb fluid fee on there and I wouldn't know the differences if that was legitimate or not. So I think it is important to be able to disclose these fees, and these regulators have stepped in to hopefully do that. But again, like you said, not everybody is acting in a fiduciary capacity, and they don't always have to disclose those fees, but we do. So
that's a great example too. Yeah, if you do go to work, have your car worked on, for the most part, it would be crazy just to blindly say, well, just fix it. I don't even care what it's going to cost. But Trey, that's kind of what goes on in the financial world. Like Wes said, most people don't understand fees, don't know what to ask. The clients will tell us that. I don't know what questions to ask, and just kind of blindly turn their money over to people.
Yeah, we do fee analysis on the front end. A lot of times when we're moving brokerage accounts that are already in IRAs, money that's been invested with another advisor, they come looking for a plan with us. When we put together these fee analysis, it dives into what the positions are, and I think we've got one of those that we can take a look at.
Yeah, in fact, Heather, it looks like, now this, you could describe this, that this one, basically, we save this person every year. Now, this isn't going to happen all the time, but over $10,000 a year in fees. So what is this analysis? Who's doing this in the office? And where do we find this information to accurately compare these fees maybe versus what they would be paying with us?
Yeah, so that's one thing that is really important when you meet with us, to bring your full IRA statements, because we use that document to determine the report that everyone's seeing right now. So what we do is we look at the individual holdings of somebody's portfolio, especially with mutual funds and ETFs. They all have what's called expense ratios. So that is just the cost of investing into a particular fund. So we look at those, our calculation, we weight those against the entire amount of the portfolio, and then also determine what the advisory fee is on top of the expense ratios that they're paying. Then we compare that to what we provide, and Wes will speak to this, I'm sure, but when we build out our portfolios on our Schwab platform, we look for low-cost mutual funds and ETFs that are not going to trigger a lot of expense ratios. We're always mindful to try to keep the fees lower for our clients as best that we can.
Yeah, so Wes, speak to that in terms of the things we're selecting with Schwab.
Yeah, really, when it comes down to brokerage assets, money in an investment account, there's really usually two sources of cost. One is the expense ratios themselves of the funds that you're buying. So before any advisor gets paid, before any financial firm gets paid, all these things that you own inside the account have their own little expense ratios that you're paying for. And then there might be an advisory fee on top of this. We're going to talk more about this later. Different financial organizations have different ways they get paid, but most people will charge an advisory fee that's really just a fee on the total amount of money. There's another way you could get paid, which is to physically write a check to your advisor for the services they're providing. But the financial world has found that it's so much easier to just draw a fee directly from the account because the person never really sees it come out. Not saying it's a bad thing. It's, just the cost of doing business. But if you were writing these checks physically to these different mutual funds companies and ETFs and advisors, I think people would pay more attention to how much money is actually being spent to procure these products.
Yeah, I think what people are used to saying what they're paying for these advisory services is what Heather alluded to, the advisory fee. It's usually around 1% to manage money. However, we've seen these fees creep up to 2% by the baked-in cost of these expense ratios.
Yeah, let me reference, so this was probably one of my favorite books. Years ago, I grabbed it, John Bogle on Investing. I know all of you all are fans of John Bogle. I sure was. Obviously, he's passed away since then, but this book is a classic, and it's referencing what he noticed years ago when he came up with the idea of Vanguard, low-cost fees, etc. But on page 39 of the book, now these are examples he used, but here are all the different costs most people don't see. A fund load, some are loaded. You got 6% up front, but on top of that, you've got a 0.5% fee. You've got an opportunity cost of 0.6. You got fund transaction cost, maybe a 0.7, the operating cost of 1.2. So he said by the time you add all this up, you're up to 3%. Again, costs nobody ever sees. Then, and I love this part, then he lays on top of that, we'll talk about this in a minute when I cover something later, then you talk about the taxes, which might be another 2.7 or 3. So what he's saying is, on an account earning whatever it earns, there could be as much as 6% annual cost when you factor in the cost of taxes.
Yeah, I think ultimately it just comes down to disclosures. Going through our planning binders in that second appointment, I think I've counted upwards of 3 times we actually disclosed what it would cost to do business with Tony Walker Financial.
Awesome stuff. Folks, we're going to take a quick break. We'll come right back. We're talking about fees and how to reduce those fees and put more money in your pocket. This is the Worry-Free Retirement. We'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Welcome back to the Worry-Free Retirement. We're on part 3 of the different things you can expect from Tony Walker Financial, and one of those is doing our best to keep fees down. Trey, one of the things that comes up a lot is this idea of needing long-term care insurance. And before we get into more of our meat here of the topic, it just dawned on me at the break. People come in sometimes and they want long-term care insurance or they want life insurance, and then they see the premiums for it. It's like, gosh, that's $1,000 a month or so. But in our previous example, again, not that we can do this for everybody, but if we can save, this is just opportunity cost theory, but if we can save $1,000 a month in fees, that's money that could be freed up to do other things with, right?
Exactly right, yeah. We've had cases like this before where people have moved brokerage accounts over. They see what we're able to save them. In the one instance, we used an annuity with no fees. We moved it into Schwab with far less fees and less cost within the holdings. And they were able to find that $1,000 a month that you were talking about. They decided to purchase life insurance on both of them because they wanted to leave tax-free assets to the kids. So it was pretty powerful.
Heather?
Yes, Tony, that's a valid point with it. Trey was mentioning, several years ago, you really started learning about opportunity cost theory and how we can use savings to deploy different aspects of a retirement plan by saving money on one end, and then we can afford other things on others.
And, other thing that I think we think about sometimes, most of the financial world is tailoring their message. This is a great article. How do you pronounce this gentleman's name again?
Kitches, Michael Kitches.
Kitches. He's big in the financial world as far as the investment world. You say he's very well known for his speaking ability.
Big time speaker. He is renowned in the financial world to give advice and talk about planning, that sort of thing.
And so this is not a knock against wealth managers. We'll call them wealth managers. But speak to our clientele, Wes. And like this article deals with 2 million portfolios, $2 million, $4 million, other articles we scanned before we got into this. I mean, big money. Talk about the typical client we work with and try to help at Tony Walker Financial and why these fee savings are a huge deal to them.
Yeah, the financial world really kind of segments people into different buckets. They would call our, typical client what they call the mass affluent. This is between $500,000 to $1 million. Above that would be accredited investor, qualified investors, and qualified purchasers. It just keeps going up the line as far as total net worth. But our typical client is someone who's, worked a job for 40 years, who's saved money, who doesn't like a lot of risk and wants someone that can help them understand what they have and what they should do with it. From a fee perspective, anytime you're managing money, if you have more assets to manage, you can charge a smaller fee on it because there's more money to manage. If you're charging 1% on $2 million versus $4 million, you're not doing really that much extra work for that $2 million on top of it. So financial firms will typically lower their fees. We also have a tiered fee structure, but our minimums are lower and those tiers are at lower amounts than the typical financial firm.
So kind of go through our fee structure there, Trey, if you would, and explain why that fee gets very low very quickly versus some larger money managers. I mean, they're charging 1.5% on the first $500,000 sometimes. So go through that schedule if you would.
Yeah, so on this page, this is something we share with clients in that second appointment binder that we've talked about. The fee range for those percentages, the first $50,000 in a brokerage account under our Schwab platform would be 1.25%. Anything from $50,000 to $500,000 would be at 0.8%. And then $500,000 to $1 million would be 0.6. And then The any assets over $1 million in an account would be 0.4%.
And let's make a distinction here. We're doing everything in-house for those fees. All of our planning services are included in those fees, all the trading services. So, Wes, as you compare that fee schedule, what have you seen out there with some of these larger money managers in terms of comparison, especially on what they would call a smaller account?
Big brokerage, wirehouse, it's all relative. There's different fee structures, but, it might be from $0 to $500,000 is at 1.5, and from $500,000 to a 1.5 million is at 1. So that tiered fee structure, although we use it the same way they do, our bands are lower. So there's, better price breaks at lower amounts, I think, for our firm versus others. And I think it bodes well to those people who did just go work a job for 40 years and don't have $5 million laying around to invest.
And Heather, as far as making the distinction too, that does not include, I'm going to get into the a little later, maybe possibly we'll cover fees on annuities, but let's touch on the difference between Schwab and what we have to charge for Schwab and the difference between that and maybe annuities, which may or may not have fees associated with them.
Oh, absolutely. So the fee schedule that Trey just read off was specifically to the assets under management within our Schwab platform. So the annuities, we do not charge fees on personally. Some fees some annuities may carry some fees, but that is paid directly to the annuity company. Another distinction I'd like to bring up is not all advisors just charge fees. Sometimes we see that they are charging a planning fee, or if you're dealing directly with a stockbroker, a lot of times they are getting commissions, and those commissions can come out on mutual funds that have front-end loads. So that would actually reduces your investable assets right off the top. So if it has a 5% commission, you are more than likely taking a 5% hit on those funds before they're even invested.
And speak to that, because I know there's a lot of ads on TV now that dog commissions in general, but commissions aren't necessarily always a bad thing as long as they're disclosed. And then how would somebody, if they parlay some of their money and put an annuity, money in an annuity with us, how is that commission actually paid to us?
Well, in annuities in particular, the commission is paid by the insurance company that's issuing the annuity. So it does not affect the client's account value up front. So that's just built into the price of the product. We're getting paid a commission from the annuity company for selling their product, but it doesn't affect the consumer's account value.
And Wes, with that said, obviously we got to be careful with annuities, because if somebody gets out early, you're getting into surrender charges. But speak to how that split IRA works in meshing the annuity with the Schwab to keep the liquidity there and to meet the changes that will come people's way in retirement.
Yeah, absolutely. So Schwab really has one of two purposes. It's either for taking money out or trying to grow money faster than you could with insurance products or bank savings products. So, in a typical split IRA case, we would maybe break off some of the money to facilitate immediate distributions, we'll just say over the next 5 or 6 years, before we're going to take the income from a big mailbox money annuity. And then lastly, we might have a third pot of money. This is in Schwab again, that's just set for growth. This might be someone's Roth IRA. That's typically a good tax-advantaged account to put, mostly into the stock market and try to make it grow over time. But that planning expertise is what you get for that fee that you're paying. So if you're paying a 1% fee to a mutual fund company, nobody's calling you up talking about which accounts you should put this in. But if you're going with us, I think you do get the planning expertise alongside the investment acumen.
But what's interesting, Wes, we had a couple in yesterday, and it's fine. We don't care if people have money elsewhere, but speak to how important it is for people to share with us where this money is as fiduciaries as we're trying to figure out where to invest the money. I think this gentleman was worried about losing money, and we had him in growth, and he wanted to go back to conservative. Well, we found out he had several $100,000 in the bank. So why is that so important that we need to know where all of the money's located?
It's not a money grab. We're not trying to take your bank savings and put it into Schwab. That's not what it's about. We just need to know how much you have so that we can put a plan together that makes sense. If you've got a couple $100,000 laying in the bank, then we might have the opportunity to take more risk if the client's comfortable with it and better explain to them why they're able to do so. I've seen you tell people to keep, plenty of money in the bank that I think, you could turn around and say, why don't you bring that over here? We could do X, Y, or Z with it. But our typical client, I think, feels more comfortable having more assets in the bank they could get their hands on.
Yeah, I think that's really just what it boils down to with our planning is for that advisory fee, yes, we may earn a commission, but the planning that goes into it, the tax planning and advice that we give clients, all for that fee that we think is pretty reasonable, you're not going to get all that baked in elsewhere. And I think putting these game plans together for savers, it really allows them to understand the cost of doing business.
You could have an annuity contract too that you sell one time if you're an advisor. Really, there's not that much of an impetus to handle that contract in the future. You can kind of just push it off to them and say, here you go, you've got it now. But I think the benefit with us, although we did earn a commission, we are going to be there to service the product in the future.
And I think it's key that we are producing those plans before a client or a potential client even commits to us. You'll see other advisors, they'll say, okay, move your money over and we'll build out a plan. That's not a requirement for us. We want you to see the plan and the ideas that we have for for your retirement before you move forward.
And I'm going to get ready to, when we come back, I'm going to actually get the whiteboard out. I want to talk about the split IRA and use an example of how those fees will be charged and which products, potentially, depending on what we select in the split IRA, have no fees whatsoever. So folks, stay tuned. We'll be right back. It is estimated that each day over 11,000 people will turn 65, which means a lot of advisors selling a lot of annuities. Don't get stuck in the wrong annuity. Get a second opinion from TonyWalkerFinancial.com.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, thrift savings account, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For almost 40 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
Warning. A licensed insurance agent with no prior knowledge of annuities can legally toss your 401k into an annuity. Don't make that mistake. Log on now to TonyWalkerFinancial.com before ever purchasing an annuity. Welcome back to the Worry-Free Retirement as we conclude our show talking about fees on your money charged by a financial world and, yes, even Tony Walker Financial. I think one of the big misconceptions, and again, we see articles and ads on this all the time, Heather, where all annuities charge huge fees. Maybe the case with some, but not all. Why don't you go through the different annuities out there and roughly what type of fees people are looking at on strictly annuities?
Oh, sure. Generally speaking, because some annuities can be different. You'll see variable annuities are probably the most expensive that you'll come across. Typically, we're not selling a variable annuity due to risk and the high cost of them. They can run anywhere from probably 2 to, I've seen as high as 4.5% if they've got some additional riders on them. So that's just off the top, and you would, that's before you make any earnings. What we typically use are a few other different types of annuities. RILAs, which we have recently introduced, that advisory fee for us is about 1%. And then that gives you some protection against market downturns, but also allows you some pretty significant growth. Accumulation fixed annuities, so those are typically fixed indexed annuities. Those can or cannot have a fee. It depends. A lot of times we've seen some with significant bonuses. It'll be some sort of enhanced liquidity or enhanced something that you're paying a fee for, but about 1%. Typically, our accumulation annuities have no fees. Fixed interest annuities, they work a lot like CDs. Those do not have any fees. That's a good way to protect principal and earn a guaranteed interest rate. And then our income annuities, which are fixed indexed annuities, those are Some will carry fees if they have income riders. So, and then some don't. So it really kind of depends. But I think if a consumer's looking at an annuity right now, I think they need to have those fees disclosed to them by any kind of advisor trying to sell them and explain those fees. Because there's products out there that, again, you can minimize fees on, but sometimes the fee is worth the cost because of the benefit it provides.
Well, you know me, Trey, I've got 2 income rider products. I love the lifetime income riders, but speak to the fee on that and where the fee really applies, and in the end, who's paying that fee?
Yeah, you often joke and say the kids are paying the fee. The product we use mostly for income, it generates a lot of joint income that guarantees lifetime income. That's your mailbox money. But the fee is actually deducted from what's called the contract value, which you could think of as a death benefit, what goes to your beneficiaries after you were to pass.
And even in the income plans, I mean, when we're going through those, when we assume the index annuity doesn't make anything. I mean, when you start income, it's going to run out of money in 12 or 13 years anyway. So it's not that we want to belittle the fees, but even if they're charging 2%, if you live past 13 years, you've kind of beat the bank. It's not going to be anything in there anyway, correct?
Correct. Yeah, when we explain those fees, of course, that fee goes directly to the company. That's not a fee we're charging, which I think is important to understand. But that fee, it covers the lifetime income. Sometimes there's long-term care type benefits like a well-being rider, and that's all baked into that 1.2% or so. So if you think about that fee being able to provide something that can't be accomplished by Charles Schwab, that's the reason that we're using it, and that's the reason we disclose what that cost is.
There's commissions involved with annuities as well. When you get a commission from selling an annuity, it's similar to when you sell a home as a realtor. The buyer of the home does not write a check to the realtor for making the sale happen. The seller of the home, pays that commission. The buyer just knows the final price that they end up paying.
And Heather, in our time remaining, and I'll let you gentlemen weigh in as well, but speak to this concept. We got a couple of minutes left of the RILA. What does that stand for, and why have we decided to introduce this product into the mix?
Oh, absolutely. So a RILA is a registered index linked annuity. So look at that as kind of a hybrid annuity between a variable and a fixed indexed annuity. What that offers, it's fairly unique. That offers downside protection, and you choose how much protection you're going to receive. Oftentimes you'll see 10, 20, 30%, what's called a buffer. And so basically the annuity company is absorbing those losses first. So let's say you're invested in the S&P 500, you have a 20% buffer. If the S&P actually declines from year to year and it's down 10%, you don't lose any money. Now, if you still have that 20% buffer and we see a 2008 again and the S&P drops 30%, then you would see your account decline just past that. So it would go down 10%. So they'd absorb the first 20% in loss, and then you would only realize about a 10% loss.
And there is a catch with that. The upside is capped too, so that's the key. If you're going to choose more protection on the downside, you're not going to have as much upside potential. But you can change them, from my understanding, from year to year, just based on if your risk tolerance has changed or if your needs have changed.
And also from a liquidity standpoint, why does this whole product excite me with our process, Trey? Because obviously the annuities we've sold up to now have commissions, they have surrender charges, we get into liquidity issues. Speak briefly to the RILA concept.
Yeah, with these RILAs, there's no surrender charge. So you're able to get out of them if you want to get out of them. That one of the bigger knocks on annuities is you're stuck in an annuity. With planning, we usually have no concerns over surrender issues, but with these new products, they're very saver friendly.
Yeah, very, very exciting time, and we're about out of time, folks, but Heather, Trey West, thank you so much for what you do, and for the clients, I know they appreciate your work behind the scenes and working on all of these cases and the investments, everything we do. So thank you so much for being such a big part of Tony Walker Financial. Folks, you've been listening to the Worry-Free Retirement, and we look forward to seeing you soon next week. But you remember, between now and then, if you have any questions, feel free to log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Just click on that Let's Get Started and set up that free phone call, or call us anytime at 877-499-9255. Well, we've enjoyed being with you today. You remember, next week on the Worry-Free Retirement, if all else fails between now and then, you be worry-free and you make it a good one.